I've been asked to discuss the question when elites fail and what we should do about it. There's a simple answer. The simple answer is get rid of them. But then come the hard answers, and those are the ones that you're going to be working on the next couple of days. So that's the important part of this conference. And then the rest of us ought to keep working on continually, because it's going to be a long struggle. I'll just make a couple of background comments about the topic, which I hope will be of some use. First question to ask is, do they fail? And if they do, and for whom, and how? Actually, there's an interesting, simple answer to that by Adam Smith. He, of course, was talking about England, and he pointed out that the principal architects of policy in England, the merchants and manufacturers, make sure that their own interests are very well served, no matter how grievous the effect on others, including the people of England, but particularly those who are subject to what he called the savage injustice of the Europeans. He was thinking particularly of British India, but it generalizes. And that's a pretty accurate answer. Actually, there's a measure of how well it works. It's what's known as the democratic deficit, technically, the gap between public opinion and public policy, which is a pretty good measure of the accuracy of his description. I'll come back to that in a second. Today, it's not the merchants and manufacturers. We might say it's the multinational institutions and the financial institutions, but the principle is about the same. And it does raise the question how they become the architects of policy. And there's some pretty simple answers to that too. There are a variety of ways, but the easiest one is just buying elections. That works like a charm. There's a sophisticated version of that by a really fine political economist, Tom Ferguson. He calls it the investment theory of politics. And he studied American politics for over a century in these terms. It's a simple idea. Elections are occasions when groups of investors coalesce to invest to buy the state. And that turns out to be a remarkably good predictor of what policy is going to be. It's actually verified strikingly in the Obama administration. I'll come back to that too, but say a word about the democratic deficit. That has a history in our history, this country's history. The country was founded on the principle that there should be a democratic deficit. That's the Madisonian conception. You look back at the debates in the Constitutional Convention, Madison, of course, the main framer, he argued that, he didn't put it in these terms, but he argued basically that democracy is a bad thing. It's dangerous. We have to make sure that the public doesn't become involved in public affairs. So there should be a democratic deficit. And he had a good argument. The model that he had in mind was England, of course. And he said, suppose that in England there was a functioning democracy. Well, then the large majority of the population would use their voting power to carry out what we would call land reform, to take land from the rich who concentrate it in their hands and distribute it themselves, mostly an agrarian society then. And he said that obviously would be unfair. It would be taking away property from the rich. So we can't accept that. He therefore, he was actually raising a question that goes back to the first serious work on politics, Aristotle's book, Politics. Aristotle faced exactly the same question. I don't know if Madison was conscious of this or not. Aristotle considered the various kinds of political systems and their merits and deficiencies, and decided that the least bad, he didn't like any of them, the least bad was democracy, but he noticed that there's a problem, namely Madison's problem. He was talking about Athens, if the poor in Athens could use their voting power, they would take property away from the wealthy, and that's unfair. So they were asking the same question, but they came to opposite conclusions. Aristotle's conclusion was you should get rid of inequality, and he outlined what we would call a welfare state, measures that could be used in Athens to eliminate inequality, so you wouldn't face the problem of the poor using their voting power to take property from the rich. Madison came to the opposite conclusion. He said what you have to do is eliminate democracy. That'll get rid of the problem. So the system that he designed places power primarily in the hands of the Senate, which is the most remote from the population of the various branches of government that were outlined in the Constitution. And he said the Senate should be the wealth of the nation, the more responsible set of men, those who have respect for property owners and their rights. And with that, and the rest of the population should kind of be fragmented and marginalized. And that way the government can meet its obligation, in his words, to protect the minority of the opulent from the majority. And that's essentially the Madisonian Compact, and it persists to the present. In fact, a good bit of the history of the last couple hundred years is the struggle between these two answers, Aristotle's answer and Madison's answer. They're right to the present. In fact, we have a huge industry in the United States. It's called the public relations industry, which is founded explicitly on the Madisonian principle. Its founder, leading figure, Edward Bernays, back in the 1920s, expressed the same view. He said that power should be in the hands of the intelligent minority, and in order to achieve that, keep the public out of it, we have to carry out what he called engineering of consent, and that's the task of the public relations industry. He didn't explain how the intelligent minority gain that privilege, but the answer's not very difficult to figure out. By serving power, that makes you the intelligent minority, and then you can manage the society for their interests, following Adam Smith's principle. The progressive democratic theory took exactly the same view. So the leading public intellectual of the 20th century, in his progressive essays on democracy, as they're called, Walter Lippmann, essentially elaborated the same view. He said the public must be kept to this status of spectators, not participants. And the reason is that the majority is ignorant and stupid. And if they're allowed to participate, they'll just make mistakes. So the responsible men, that's us, we have to ensure that we're protected from the trampling and the rage of the bewildered herd, those outsiders, the stupid and ignorant outsiders. And he was expressing a very common view. I mean, it has harsher versions toward the right, but it's a pretty standard view. And it goes way back. The problem goes back to Aristotle, and the possible answers are pretty much those. The public relations industry was founded in the freest countries in the world, in the United States and England. And the reason was straightforward. Enough rights had been won through popular struggles, so you just couldn't control the population by force easily anymore. In fact, most of this was in the 1920s when women finally got the right to vote, a little bit after they got the right to vote in Afghanistan, incidentally. But they did get it, and that meant another, one of the many steps towards, there were parliamentary labor parties, unions. It was just hard to control people by force. So you had to turn to engineering of consent, what Lippmann called manufacture of consent, to ensure that the democratic deficit is sustained. That's a leading principle of democratic theory. Well, people like you, we're all dedicated to trying to build democracy from below. But the elites who we're talking about have an opposite goal, naturally, that they want to undermine democracy from above. And that's perfectly natural, and it's general, shouldn't be surprising. The U.S. may be a little different from similar societies in this respect. It is unusual in the strength of business rule. The United States happens to have a highly class-conscious business community, which is committed to fighting a continuous and very bitter class war. They're not secret about it. Read it in business publications. They're concerned with what they call the hazard-facing industrialists and the rising political power of the masses. And they have to crush that somehow. And there are many ways. At one extreme, just violence. The United States has an unusually violent labor history in comparative terms, compared with similar societies. The softer end, there are things like the commitments of the public relations industry, fabricating consumers, directing people to the what are called the superficial things of life, like fashionable consumption and debt traps and other devices. And there's a wide range of devices. They're used with dedication, consciousness, a kind of a vulgar Marxism, just values inverted. And that's a good part of our history up to the present. Well, let's turn to the Obama administration and what we can learn from it about the question when elites fail. Well, from one point of view, they have failed dramatically. The two major foci of these discussions or illustrations, the financial and the environmental failure. And that's pretty serious. And it does, as Smith pointed out, have a grievous effect on others here in the United States and the other rich countries, but much worse in the countries that are subject to the savage injustice of the Europeans, South suffering much more as usual. Not all of it, the metaphoric South outside the West. East Asia has been pretty much immune, but that's because they protected themselves from the neoliberal doctrines of the past 30 years, and hence they've survived much better. And to an extent, that's beginning to happen in Latin America, one of the most important developments in the world at this time. I try to say something about it, but they're beginning to extricate themselves from this system. But the picture's pretty general and not surprising. Well, let's consider, I'll just keep to the effects at home. For the population, it's grievous, but I don't have to go through the details because you know all about it. There's a good, but what about the principal architects of policy? How are they making out? Well, they're making out like bandits. It's described very frankly in the business press. The business press is a very good source of information, has good reporting, for one reason, because their audience has to have a tolerably realistic picture of the world that they own, so you get pretty accurate reporting. And also because they trust their audience, so you don't have to feed them ideological claptrap. So you often get a pretty straight and accurate picture. And so let's start with Business Week. In early August, they had an issue with a big front page cover that had big letters said, "The health insurers have already won." That was August 6th. They were exulting. The battle over health care is over. They won, and they're very happy about it. And that's correct. They got virtually everything they want, the insurers. They're getting universal coverage or something like it, which means more customers, government subsidies, virtually no regulation, and no public option still being talked about, but everyone in the know agrees it's not going to happen. So it's as if they wrote the bill, and it's not as if they pretty much did write the bill. So yes, the health insurers have won. So I'm very happy. What about the public? Well, the public has opinions, but here's where the democratic deficit becomes so significant. Madison, Bernays, Lippmann, and others are correct. For decades, there have been polls among the public about what they want done with health care. And large majorities pretty consistently are in favor of some kind of national health care system of the kind that every other industrial country has, and many others. But that's not even on the agenda. It's occasionally mentioned. When it's mentioned, it's called politically impossible or lacking political support, which is accurate, in fact. It lacks support from the principal architects of policy, the financial institutions, the pharmaceutical industries, and so on, so it's not politically possible and not on the agenda. What about public option? Well, that, which is a pretty minor aspect of it. The public, on that, the most recent polls about a week ago, it's still about 2-to-1 in favor by the public, but it's finished. It's not going to happen. What about drug prices? They're about twice as high here as in the rest of the world, and a pretty simple reason for it. This is the only country where the government is barred by law from using its purchasing power to negotiate drug prices. 85% of the public's in favor of using that power, but it's off. There was a front page story in the New York Times a couple of weeks ago saying Obama has made a secret deal with the drug companies, ensuring them that there won't be any effort to negotiate drug prices. Pretty big democratic deficit, 85% in this case. The numbers, incidentally, are misleading. If these issues were ever discussed, they're not, you know. Then, and if people didn't feel isolated and alone and giving these opinions, the numbers would almost surely be much higher. But even with no discussion and just total either ignoring it or condemnation across the board, the figures stay pretty stable. And that's true on many other issues too. It's been studied well. Well, this is an enormous elite success. Incidentally, as you know, there's a lot of talk about cost control. You got to keep the cost of the health reform under that magic number of $1 trillion. But that most of the discussion is completely ridiculous. If the public will were honored, there wouldn't be any cost problem. The cost would be going down. So the costs of drugs would be going down, as they are in the Veterans Administration, for example, where the government does have the power to negotiate prices. And if you got rid of the insurance companies or tightly regulated them, as is done in some European countries, it'd be enormous cost savings. But that doesn't matter. That's only what the public wants. And it's not what the principal architects of policy want and what they've gotten in a pretty dramatic illustration of the accuracy of Adam Smith's observation 250 years ago. Of course, there's a potential downside, and the business press is quite aware of it, and the business world. It's going to tank the economy. Take a look at the escalation of medical costs. You know, it's going to overwhelm the economy. But that's not an issue either, just as the public will is not an issue. And it's not because they're bad people or anything. These are just institutional imperatives. If a person's functioning in those institutions and does care about what's going to happen, say, to their grandchildren, they're out. They can't participate. The structure of the institutions is such that you must be concerned with achieving the goals of the principal architects of policy, short-term gain, profit, and power. Otherwise, you're out. So it's institutional fact. Well, what about the banks and the investment firms? They're just as delighted as the insurance companies. And again, the business press actually expresses it better than I can, so I'll just mostly quote. You see headlines in the New York Times, in flurry of big merger deals, signs of restored confidence. investors eager to take risky investments. Profits and bonuses are kind of, off the chart. And in fact, why shouldn't they take risky investments? They're not risky. They've got a government insurance policy. There's a huge public bailout, no meaningful regulation, and there's a very significant increase taking place in the government insurance policy for risky investments and loans. It has a name, which it's called too big to fail. If you're too big to fail, you get a government insurance policy. Well, bank has an insurance policy, sure. Investment firm, it'll take risky loans, risky investments, and make a lot of money, and if anything goes wrong, you pay for it. So, yeah, now it's more extreme than it was before the financial crisis. One of the really good economic correspondents, Gretchen Morgenstern of the New York Times, says too big to fail is just too big to take on. We can't deal with that. Much getting too close to the centers of power. So here's the Washington Post, which says it a lot better than I can, so I'll read it. It says, headline, "Banks too big to fail have grown even bigger. The behemoths born of the bailout reduce consumer choice, tempt corporate moral hazard." When the credit crisis struck last year, federal regulators pumped tens of billions of dollars into the nation's leading financial institutions. Today, the biggest of these banks are even bigger. The crisis may be turning out very well for the behemoths that dominate U.S. finance. A series of federally arranged mergers safely landed troubled banks on the decks of more stable firms, and it allowed the survivors to emerge from the turmoil with strengthened market positions, giving them even greater control over consumer lending and more potential to profit. These mergers were largely the government's making. Regulators pushed failing mortgage lenders and Wall Street firms into the arms of even bigger banks and handed out bigger billions of dollars to ensure that the deals would go through. The oligopoly has tightened. It's only in economics departments that they talk about free markets, not in the real world. The oligopoly has tightened. Today, even with the memory of the crisis fresh in their minds, creditors are granting big institutions more favorable treatment because they know that the government is backing them. Large banks with more than $100 billion in assets are borrowing at much lower interest rates than the rest of the industry. And many of the largest banks reported a surge in profit in the most recent quarter, including J.P. Morgan Chase and Goldman Sachs. Now, they're prospering while many regional and community banks are struggling, failing steadily. The Center for Economic and Policy Research, great research institute in Washington, just issued a report showing that the subsidies that the too big to fail institutions received constitute a substantial redistribution of money from taxpayers to the very banks that were bailed out last year, with grievous effects on the public and on community banks that service them, and in fact on everyone who's too small to care about. Now, people aren't happy about that, naturally, and there are demonstrations and protests, and it's pretty common to ridicule the protesters. And in fact, there is a fair amount of nuttiness and craziness, but there's a very serious motivation behind it. They're basically right. They should be protesting. And the question we should be asking ourselves is why they're not being organized by the left. That's the natural... That's the natural audience. They're not to be ridiculed. I mean, they are coming up with ridiculous answers, but those are the only ones they hear. I mean, the only answers they hear are coming from Rush Limbaugh. The liberal Democrats are not going to tell them why this is going on, and the left has really failed. And the consequence of that could be ominous. It's not a matter for ridicule, it's a matter for organizing, a serious one. Well, too big to fail is, of course, an insurance policy. It exacerbates a built-in inefficiency of markets, inherent in markets. So for example, if, say, you sell me a car, if we're paying attention, maybe we'll make a good deal for ourselves, but we don't take into account the effect on others. And there's an effect. So if I have a car, increases congestion and pollution, and price of gas goes up. And these may seem small, but when you add them up over a large number of people, they're large. Well, in the case of banks and investment firms, there's a name for it. It's called systemic risk, which is underpriced. So if Goldman Sachs makes a loan, they take into account what happens to them if the loan goes sour, but they don't take into account, and that's a fact about markets, they don't take into account the systemic risk, the effects on the whole system if the loan goes sour. Well, that alone is enough to guarantee crises, repeated crises, and there's nothing surprising about it. It's well known to economists. About 10 years ago, there was a good book on the topic by two very good, well-known economists, John Eatwell and Lance Taylor, called Global Finance at Risk, simply pointing out that the property of markets that underprices risk by ignoring systemic risk is bound to cause crises, as it has in the past. Well, that was ignored. There was also a famous comment by Alan Greenspan, or St. Alan, as he was called in those days, in which he made some comment about irrational exuberance. That was during the tech bubble of the late 90s, before that crashed and followed by the next bubble. And he's been criticized recently for not having acted on that comment, but that's the wrong criticism. He was incorrect. It's not irrational exuberance, it's very rational exuberance. It's very rational to take huge risks, make a lot of profit, and if anything goes wrong, go to the friendly taxpayer to bail you out because you're too big to fail. That's the way the system works. It's extended by perverse incentives like the too big to fail insurance policy and many others. So perfectly rational exuberance. Well, as the business press also points out, this just sets the stage for the next crisis, a worse one, because they keep getting worse as the system gets more and more complex. But that's okay too. That's not our problem. Same as in the health insurance industry. It's an institutional fact. You have to ignore that. Otherwise, you're not in the game. That's the way the institutions are constructed. Not bad people, just institutions. Well, all of this is part of the neoliberal programs that began to take off in the 1970s. One critical aspect of them was the financialization of the economy. Back around 1970, financial institutions maybe amounted to 3 or 4% of gross domestic product, and now it's probably 10 times that high, if not more. These are state corporate programs shifting this focus of the economy to financial institutions and transferring productive capacity abroad. Doesn't mean the manufacturers are losing money. It's fine for Dell if computers are produced in China, in fact, better for them, cheaper labor, so on. So there's a whole system which is transferring productive capacity abroad. It's being recognized by the right wing, which is screaming about it. So you listen to Lou Dobbs and those guys, Rush Limbaugh, saying, yeah, we're losing our productive capacity. They're right, they just have the wrong answer. And if their answer is the only one that people hear, the country is facing real dangers. I mean, I don't want to exaggerate, but it's worth remembering that Germany in the 1920s was the most civilized part of the world. It was the peak of Western civilization in the sciences and the arts and literature, in democratic functioning. It was kind of a model. We know what happened 10 years later, and there's a kind of a, if you listen to talk radio and you watch the demonstrators and so on, there's a familiar sign. These are people with real grievances. I mean, they've been smashed by 30 years of neoliberalism, and they're not getting any answers, except the ones that they're getting from Rush Limbaugh and Glenn Beck and so on. And they have an internal logic to them. They may be crazy, but they have an internal logic. If you accept the premises, it sort of hangs together. And those are the only answers that they're hearing. That's very familiar, and we remember what it led to, worth thinking about. The neoliberal programs have a broader structure. They're designed to set working people around the world in competition with one another, so they all are driven down to the poorest. Meanwhile, professionals are protected, so they're not placed in competition. And of course, owners and managers enrich themselves. There's a name for that too. It's called globalization. It's basically its structure, and it has obvious consequences, which we're witnessing. And sometimes, in fact, the consequences are really surreal. It's surprising that there isn't more discussion about them. So take right now, you read the front page of the papers now, say General Motors is dismantling its plants, destroying the lives of the workforce and communities. At the same time, Obama's Secretary of Transportation is traveling through Europe, Spain, France, elsewhere, trying to arrange with Spanish companies to provide, to use federal stimulus money, taxpayer money, to provide high-speed transit to the United States. Now, the same factories that are being dismantled could do it, but it just doesn't pay for the banks and others to do it this way. It's better to destroy the communities and pay Spain to produce the high-speed transit, which we desperately need. In fact, the world needs if we're not going to intensify the environmental crisis beyond repair. And all of this goes on with no comment. Is there anything that can be done about it? Yeah, there is, in fact. Maybe the banks don't want to do it, but there's nothing in principle to stop the workforce from just taking over the factories. There's nothing in economic theory that says there's anything wrong with it. In fact, if you look at the technical textbooks on corporate structure, they point out that there's no law of economics that says that industrial installations or any others should be run in the interests of shareholders. Shareholders doesn't mean somebody who has, a share of stock from a pension fund. It's very highly concentrated. So that's not a principle of economics. There's no reason, they say, why they can't be run in the interests of what are called stakeholders, the workforce and the community, which means taking them over and running them effectively to produce what's needed and to keep the communities alive. Now, that's actually been tried occasionally. There's one really important case in Youngstown, Ohio, about 30 years ago. It was led by Stoughton Lind. The U.S. Steel was closing down the main steel plants in Youngstown, which essentially puts the community out of business and the workforce. And there were protests and sit-ins and so on. They finally organized and tried to take it to court to let the community and the workforce take over the industry that U.S. Steel wanted to get rid of because the profits weren't high enough for them. Well, they lost in the courts that time, but with enough popular support, initiatives like that could succeed, and they could lead to a real serious restructuring and reorganization of the economy and the society, which would go a long way toward overcoming the democratic deficit and creating a really functioning democratic society, including the economic institutions as well. Well, that's all right there, to be reached for and maybe grasped. It's not so exotic. Sit-down strikes of the kind that took place in the 1930s and occasionally now are just one step short of taking over the factory. That's why they struck such fear in the hearts of the business community in the 30s. One of the reasons the New Deal measures were passed to try to calm this down, because that's a step in this direction, and there are others, not utopian. Well, why are elites benefiting so much from their failure? In other words, they're not failing, they're doing fine. Well, just look at who Obama picked to fix up the economic crisis. First person he picked was Robert Rubin, his senior advisor. He was Secretary of Treasury under Clinton. His great achievement was to dismantle the Glass-Steagall Act, New Deal legislation that protected commercial banks from risky investments. So he broke that barrier. He quickly left the Treasury Department, joined Citigroup, became a director. Citigroup made use of these new opportunities to make a ton of money. It's what happens when you make risky loans, guaranteed by the government. It crashed. Rubin took off with his gains and became Obama's chief economic advisor, the one who laid out the program for him. The next person Obama picked was Lawrence Summers, who followed an economist who followed Rubin as Secretary of Treasury, and his great achievement was to block any regulation of exotic financial instruments, derivatives. It's another factor that drove the economy into disaster. So he's the next in line. And the next is Timothy Geithner, who was head of the New York Fed, which supervised, that's where all these things happen, and he was sort of on the scene supervising the financial crisis and meltdown. So he's the next, and so it goes. Actually, the business press had an interesting rundown on this. Bloomberg News, one of the main business journals, did an article where the reporter just went through I think it was 17 people who Obama called in when he came into office to figure out how to deal with the crisis, including these. They went through each one and their records, and the conclusion was these guys shouldn't be meeting to fix the economy. They should be in court facing subpoenas because of the financial manipulations, the accounting tricks, robbery, and so on. Well, that's the business press. But it makes sense. Well, take a look at the campaign and remember Tom Ferguson's thesis. Who are Obama's funders? Well, concentration of funding, the heaviest concentration, was in the financial institutions. They preferred him to McCain. They figured he'd do a better job for them. And in fact, that probably swung the election if you take a look at the details in the swing states. So yes, the standard theses work out. You buy the election, you get your policies implemented. So it's not too surprising that they're exulting.